So I'm going to say something contrarian. I'm going to say stop looking at PE ratio of stocks. You know PE ratio, right? PE ratio is market price of the share divided by earnings per share of the company. The higher the PE ratio we think, the overvalued the share is. So we try to estimate value of the stocks by seeing PE ratio. We say if the PE ratio is high, it means stock is overvalued, and if it is low, the stock is cheap. But what I want to say is nothing can be further from the truth. Why? Because looking at the PE ratio is not valuation of the company. At best, it's just a pricing metric of seeing how much is company earning and how much is the company being priced by the markets. I say that's why stop looking at the PE ratio of stocks. So you say, okay, don't look at PE ratio, then what to look? So I say, whenever you're looking to invest in a stock, here is a quick fix to understand the margin of safety in the stock. Margin of safety, right? We all know margin of safety. So I say, instead of looking at the PE ratio as MPS by EPS, change your perspective. Look at the PE ratio in this way. Look at EPS by MPS. And what does that give you? It gives you earning yield on that share. What is earning yield? Well, when you're looking at the earning yield of the share, you're looking at the current market price of the company to its earnings. It effectively changes your mindset. It changes your thinking and it forces you to think what will be the returns or the yield you will get if you invest in this share at this current market price. Now you may think, Mohit, what you have said or what you have done is just change the PE ratio. But do you understand how it changes your thinking? We are still looking at the same metrics, that is earnings and market price. But now, instead of valuing the share by number of times of the earnings, now we are thinking how much earnings we will make if we invest in this price. It effectively forces us to see if the price is right or not with regard to the earnings. Here's the secret. This is exactly how Benjamin Graham, yes, the father of investing by Warren Buffett, this is how Benjamin Graham used to calculate margin of safety. He used to compare earning yield of a bond and earning yield of a stock of the company to calculate margin of safety, which was inherent in that price of stock. So for example, let's assume if the bond's earning yield was 10% and a stock which earns $10 per year was trading at $100. That means the stock has the same earning yield as that of a bond, right? So this is how he used to look at the PE ratio. He used to look at PE ratio like in the way. So this is how you should think of PE ratio. Don't think of PE ratio as a valuation metric. Think of PE ratio in terms of earnings yield.